Farmer Jim, I begin with you. The man formerly known as Mr. All-In. He should just be known as a symbol right now. You get off being Mr. All-In just as the market starts to take off, Jim. What gives?
Scott, you are incorrigible, my friend. Don't give me any credit for the fact that I was
it's the facts.
I was
the facts are the facts.
For like 99% of this run. But okay, all right, listen, here's what's going to happen. We are having this end-of-year run. I have already started to trim, and next week I will start to trim. I think the market's going to go higher next year, but these are the facts. We're up 29% year-to-date. We're up 21% on average the last 2 years, 17% over the last 10 years. Guys, that just can't continue. And what's the catalyst that brings it down? It's really simple. It's just that the Fed has turned a little hawkish. Now, nobody needs to lose their mind about it. I'm not losing my mind about it. But next week, I'm going to trim some Apple.
Well, you're not losing your mind. You're not losing your mind, but you might lose some money. You're not losing your mind, but you may lose some money.
Scott,
I mean, the Fed's. Jim, what do you think's going to happen? The ball's going to drop in Times Square, and Jay Powell's going to raise interest rates?
No, Scott, here's what I think is going to happen. And I think, honestly, you could listen to me and maybe learn something here, okay? You need a catalyst for valuations to come down. You need a catalyst, and the Fed is it, okay? Their taper is going to be done by March. They're making noise about raising interest rates. Look, I'm not saying we're not going to have a good 2022, but I do fully expect a 10% plus correction in the first quarter. And what I will not do is ride it down and then sell shares and say, oh, look at me, I'm so cute, I'm selling here and buying there. No, you got to sell when they're high. That's how this game works. So I'm going to trim next week. I already started by taking out Northrop Grumman. I'll trim those trading shares in Apple next week. I'll raise about 10% cash. And I'll have my dry powder, and you and I can have our fun going back and forth as the first quarter develops.
All right. I mean, I like the bazooka you're firing back at me. I can take it. That's all good. Kevin O'Leary, it's good to see you again. My man, it's been a while. How about this strategy? Farmer Jim's already driving his tractor out of the exit. Should we be doing that? Are we ahead of ourselves? Or it's so good now that we better, start to lighten up a little bit, take advantage of this move we've had into the end of the year?
Well, I'm a Farmer Jim fan, but I'll take the other side of that coin right now, and here's why. Right now, think of the big picture. We're going to print just under 6% GDP growth Q4. Because of the confusion around COVID and how long it's going to last and what it would do to the global economy over the next quarter, the prints have been cut down below 3% for Q1. Now, I think that's way too pessimistic, so I'm going to stay constructive stocks. The problem with going to cash right now is you're going to lose 5.5% of its value every 12 months. That's the tax of inflation. We now have this bill that's dead. Build Back Better is gone, which is really good. We've got total gridlock in Washington, really good. And at the same time, let's say PEs, price-earning ratio about 24 on the SP right now. Let's say we get no PE expansion. Earnings, I believe, are underestimated for Q1, Q2. I think we'll get 8% next year in earnings growth. Why wouldn't you want to stay constructive in stock? Jim is trying to time the market. He will pay a horrible price for that. I will let him cry on my shoulder later.
It's hard for me to pay a horrible price if I raise 10% cash. Okay, if I'm 90% invested and the market goes up 20%, I'll be up 18%. I'll cry myself to sleep every night.